who sold on that first large up day, he maximized his profit and locked in his equity curve at that level rather than taking it higher and then back down. And for those of you who don't understand what I'm talking about with time and experience, you will. And to Mark's point, you want to continue to add alpha. And the best way to do that is to use that strength, especially that outsized strength, where this stock's been moving up in a nice trend and then it accelerates. That is that sign to say, lock in some of those gains and take advantage of that strength for selling.
So regardless of if the stock goes higher or not, when you sell into strength, you're selling at the highest price that the stock is traded up to that point. So you have no drawdown at all, right? Your equity curve is at the highest level. And this is why when you take a look at someone like Mark's trading or my trading or anybody who's really good at managing risk versus reward, and they're using strength for selling, and they understand this, you're going to see this stair stepping where their account will go up and then it'll just flatline and it won't go down very much because they're always selling and protecting that drawdown by selling into strength and not allowing the stocks to come back very much. And this is where, this is on one stock. If you have a whole portfolio and you've got 10 stocks and everything's going great, it's just like when you go on, for those of you who ever played craps in a casino, you go out there and you put some money down and now you've got the 8, and then you put some money, another roll, you start putting bets on there, and before you know it, you got a whole bunch of bets on the table. You got the 8, the 6, you bought the 4, and you took a hard way, and 7 out, boom, you lose them all. Right now, there's this giant drawdown. You've built up all this money, but it's out there exposed on the table. So that's what really hurts your performance more than anything, more than not getting the gain, because even small gains can add up. If you can minimize the downside and you don't have much drawdown. If you're not losing, winning becomes much. The first rule to winning big is not losing much. And that goes for having drawdowns. So let me show you a few more examples here. I know we're getting a little long-winded here, but so here again, stock gets into that stage 2 uptrend. And this could also be, it doesn't have to be a late stage. This have to be a 4th, 5th stage base. This could be the very first base. And maybe if you're swing trading, this is precisely how you want to trade and trade out of these positions. However, if it's a later stage base, it's even more important because then the stock it has a potential of breaking faster and even harder because now the stock's gone up so much for so long, it's become obvious. You got all these institutions in there and now there's nothing but supply. So here, 11 out of 15 days up, right? That's your first run up. Then you pull back here, you actually get a little cheat area. You get another little opportunity, whether you traded out of it and you bought it back or you stuck with it or you added to your position here. But now you get that second run up where when you get 2 of these somewhat back to back, usually they'll happen either back to back with a little pullback in between or one base in between. 70% of the days up over a couple weeks, 11 out of 15. Now you got 13 out of 15 days up, largest up day, which if this was breaking out of initial base, this would be a great sign. I probably would hold the stock and let it go through a couple pullbacks and try to go for a bigger move. But this is happening after it's already moved up quite dramatically. This stock came out of this first base here, $8. It's now a double in a short period of time, and it goes up 53% in just 5 weeks on a gap, largest up day. See, this is all starting to come together. Big volume coming in. It's getting very climactic now. So that's where you want to sell right into that. Same here. Here's Tesla. And again, sometimes it doesn't mean that the stock has to top out forever. Sometimes this just is enough to stall the stock for a period of time, sometimes 6 months, a year, where you could then move that capital somewhere else. But again, you came out of this base right here, bunch of gaps, 1, 2, 3 gaps, largest up day, widest spread, up 10 out of 14 days, up 51% in just 14 days. See, again, I'm selling right into that. I'm selling into that every time. I'm selling right into those, all those sell rules piling up. And then you see, sure enough, stock comes in, you give back all that gain. I'm not going to go through every one here. Well, I'll go through them just really quick. Again, largest up day, widest spread, 1, 2, 3, 4 bases, and now you get the acceleration, 58% in 5 days. If you're not happy with that, even if you bought it from here, just the 58% in 5 days, not considering that you bought it earlier, would be a nice quick return on your money. Again, here you see comes out of a base here. Now getting later stage. This is actually on earnings. Sometimes you'll have earnings and the stock will gap and top on good news. Again, for some, it might be hard to sell because, oh my God, they just came out with this great earnings report. 50% in 9 days, up 7 out of 9 days, largest update, reversal off the top on the largest volume. So this really in one day, you've got a whole bunch of sell signals all at one time. All right, let me show you a few more. Same thing here. Now, another thing to look at here, I talked about acceleration. What does that mean? Well, first we come out here, right? Then we accelerate here. And now look at the angle of ascent here. You see how we keep our angle is getting steeper and steeper. That's where when you get late stage, as you start to accelerate, this is unsustainable. When you first break out, it's unsustainable, but it's early. So you get some pullbacks, you'll get some rebasing, and the stock can move higher. Once the stock makes a big move and it's run up and it's got extended, and it's on gaps, and all these things have occurred, that acceleration now becomes unsustainable. And usually the selling that comes into that, the big institutions, they'll start selling into that, and then they'll overwhelm that short-term demand. That supply now will work just the opposite. As it was gobbling up the weak hands, it's now going to run over the weak hands. It's going to take those weak hands out, and there's going to be no bids.
And Mark, the way I like to describe this sometimes, that's helpful for folks, is everybody's ever gone up a hill. If you start jogging up the hill and then running, if you sprint up that hill, at some point, if you don't stop, you're going to collapse. And that is precisely when these stocks start going parabolic like that. You can see, as it shifts higher and higher, whatever your analogy, same when you ever into an air show and that plane flies straight up, it's just, it's telling you it's going to have to stop. And the longer it goes without, to your point, you're risking then that bidless situation where it gets really volatile, and that's what you don't want to be around for. So even if you sell early beforehand, you're avoiding that volatility, which will pay handsomely in the long run.
Yeah, selling into strength is the hallmark of a pro, and is one of the key points to making big returns and having low drawdowns and being able to compound your capital. I can't stress it anymore how important it is to get good at selling into strength. Now,
that's something everybody should write down, by the way, that selling into strength is a hallmark of a pro. That should be on a sign somewhere.
As Mark was saying, that think about it as here, you just start a running competition, and you're completely rested. And now as you start running, that initial, you come bursting out of the starting gate, and from being rested, obviously your heart rate now moves up, but you can go and run the race for quite a while, right? You go through this marathon race, but at the end of the race, you're all out of energy. Your glycogen is all depleted. You're tired. Your heart has been racing, and now if you were to then push yourself and accelerate from there, you would not be able to go very far for very long. It's the exact same thing that happens with a stock. So think of it in those terms. So again, just looking at some of these examples, I'm just showing you examples of how stocks will either top or stall. And you can see again, up 7 days in a row. This is making me happy here. It's breaking out of a base. This is one actually, Fair Isaac. I bought this coming right out here. Runs up. You get another little base here. 7 out of 10 days again. Now we've made a nice little move here. We've doubled, and you get the big break. Price break on the largest volume after you've had these number of tranches of 70% or more up days, and now you start getting toppy. The 50-day can't hold, and you see you come off here. This is something you got to get really good at identifying on the upside on your profitable trades, so you can avoid getting caught in the downdraft. And this is what the downdraft looks like. This is what Mark was talking about earlier, is like the last straw. I mean, this is the straw that breaks the camel's back. This is the absolute. I am virtually never in this situation unless it's by pure surprise that there's like an earnings report comes out and I'm torpedoed, or some news comes out of nowhere. Otherwise, I'm never waiting for this type of scenario. But the largest break on the largest volume, daily and weekly. This is a weekly here. That's the largest weekly down week on the largest weekly volume since the beginning of the move. That is about your biggest sell signal, or biggest signal that institutions are piling out of the stock, and that it's just the beginning. It happens over and over and over. You see again in lumber liquidators, you had that first selling off the top here, big down day. That's your biggest down day. And then it comes off. And after it's down considerably, another one, boom, right? And now the stock is actually cheap. There's people were making a case for this. I remember they were talking about how it's trading low, its lower range of its PE ratio, and it had a little pop from that, and then boom, that selling comes in again, and now it really starts to pick up. And now after the stock is down, all of a sudden the PE jumps because all the bad news starts coming in. See, the smart money's getting out, anticipating the bad earnings, the bad news, that all of a sudden what looked cheap is more expensive than ever, literally almost overnight. This is how it works in real life. All right, here's TME. This is one I bought right here, and this had a pretty short lifespan. Was acting fine, had a little volatile right here. It came out of a base, but look at that reversal. That is definitely low volume out, high volume in. So if you're buying off of this base right here, this would be run for the hills. But big break, volume comes in, and that was it.
Mark, yeah, this was a good example. This was actually a name I was playing for a bigger move, and I blew out of the remaining shares on that big break day. It was just a classic, five alarm fire going off, saying major change in character.
Yeah, so this was the daily on TME, and this was the weekly. So see, they both took that day first, and then that week was giving you a clear cut out there. This is a snap that was recently, and I compared it to Crocs. If you see, Crocs came off the highs and just wham, that was it. And same thing with Snap. Snap came on. I remember there was a bunch of fundamental investors that were loving Snap here as it was coming down. And I know many of them have been selling it recently. Now that it's down, I don't know, 70, 80%.
Snaps down even. Mark, it's funny. Go back to that chart just to highlight this. We often say, if something falls 80% or 90%, how much more can it fall? Another 80 or 90%. Because I believe Snap just in this last earnings lost another 30, 40, 50%. I think it's trading, in the low teens maybe now.
Okay. Yeah. So yeah, this chart is
just got worse.
Yeah. And Meta, Facebook, of course. Remember, highest PE before, just like we showed in the valuation section, Meta, previously Facebook, was no different. Highest PE before a big move. Now has the big break. This is the largest down week since the beginning of the move, and the volume was big on this. I don't have it here, but at the lowest PE, it's the lowest valuation. It's the cheapest right here. And this, of course, I believe is down even further. This is as of 10/23. It broke again just recently.
Yeah, it's under 100 currently.
Yeah. So now, I think, let me just see here. Okay, sorry. Yeah, we're going to keep going. All right. So I want to show you here a couple sell rules, or that we looked at sell rules on the upside. I talked about selling into strength, but you also can use sell rules that are selling into weakness. Okay, and so that would be backstopping sell rules that you would require the stock to come down and hit some level based on either, in this case, we're going to base it on a moving average. So we call this the 50-day break even or better rule. And let me just say that this rule is best used in the early stages or the early buys that you have coming out of a bear market, when you first go back into the market and you start buying some of the initial movers, the stocks that are meeting that criteria that we talked about, the relative strength lines moving into new high ground, stocks that moved up the strongest off the lows, got into new high ground first, the leaders. You get those leaders that are coming out of their bases, out of those VCPs, right in the beginning of what could be a new bull market, because you're in a bear market. So stocks that right now we're in a bear market, stocks that are starting to break out of bases, these are the ones where you might want to take off some into strength to cushion your risk. If the stock goes up 10%, you've got a 8 or 10% stop. Well, now you're free rolling. If it goes in and stops you out, you are breaking even. So you've de-risked the trade, right? You've removed the risk. However, so if you want to play it for a real big move, you can, when you first get into these stocks that take off out of those initial bases, they can go a tremendous distance before they even have a close below their 50-day moving average. And going back to the AccuStaff, remember I bought that 1,000 shares of AccuStaff back in 95, that stock went up 400% before it even closed one day below the 50-day. So this is where we came up with the 50-day or better rule, where what you do is you have your stop, right? But once the 50-day moving average moves up to your break even point, then you switch over to the 50-day. And I like to use a close, but of course, if it close would mean waiting till the end of the day. So if it was getting much below the 50-day, it would be a judgment call whether you sell intraday or you wait for the close, because obviously you can do a market on close, but it would have to be below the 50-day. But the general rule is that you're going to let that stock, ride that 50-day, and until it closes below it, or even a weekly close. If it just closes a little bit below it and you're near the end of the week, see how it closes the week. Sometimes it'll come back. It'll end the week above the 10-week. And this will allow you to not only lock in some profits that are probably even bigger than you would get, maybe selling into strength earlier, and occasionally you'll hold a big winner where it'll just make this big move and it won't undercut the 50. I use this on occasion, like I said, and I use it on usually a parcel position. Usually it's on 50% or 25% of my initial position. I'll swing trade out a part of it. And then if I think I'm starting a new bull market and I've got some key leaders and I don't want to let the tiger go by the tail, then I'll switch over to the 50-day once it hits my break even, and then I'll just let it act as a trailing stop. I just showed you a few examples. These are a few stocks that I traded and I use this rule for. The other thing that you can look for that in connection with this is that what we found is that stocks that are leaders can go a tremendous distance before they make more than 2 lower lows, or they make 3 lower lows. Remember I talked about 3 lower lows, looking at the daily after a breakout. Every lower low after 3 lower lows becomes more ominous, especially if it's on volume. You have bad closes. So you're counting those lower lows after 3 lower lows, and you want to see supportive action around that second, third, fourth lower low. You want to see supportive action. The same thing with weekly charts. And what we found was, if you just held a stock, many of these leaders, and held it until it made 3 lower lows, it keep you in the stock for a tremendous distance. This one right here, which is Burlington, which David Ryan and myself, we were both buying coming out of this initial base here. It went a great distance before it got below the 50-day or the 10-week moving average in this case, and had 3 lower lows. So either rule would have kept you in the stock for a long way. You can see right here, you come out, BABA comes out of this nice formed VCP, and all the way up through this move. Again, this is only 2 lower lows. You have not gotten 3 lower lows yet. And this is an observation that David and I worked on and confirmed by looking at a lot of the market leaders and looking at it in conjunction with the 50-day, the 10-week, and counting the lower lows. Again, it's not going to always work this way, but it's a good rule of thumb to just to watch the stock, and if you want to try to play it for a bigger move, count those lower lows. And again, see, here's 2 lower lows, 1, 2, and you'll see that supportive action. Each time you get those few lower lows, you get supportive action. That's because institutions, when there's an appetite for a stock, something really great's going on, they step up to the plate. After you got a couple lower lows and pullbacks, they step up to the plate because they don't want to run the stock up. They don't want to defeat the purpose of buying the stock. If they just keep staying in there buying these big a number of shares, they'll run the stock up. So they'll back off. Like I told you earlier, stock will run up a bit, they'll back off. Then when it pulls back, they'll go in there and they'll absorb that short-term selling. They'll absorb those weak hands, and the stock will get back into that uptrend. And then again, they'll back off. It'll pull back again. And what that character is what you're looking for. And when that character changes, and now it's the opposite, where it's rallying back, but it's getting a lot of lower lows, and just the opposite happens. Now the reverse. They're selling the shares. The bigger money is selling the shares, and they're not gobbling up the supply. They are the supply. Okay. These are a few general rules for selling, particularly for swing trading. What I do mostly. Once you get a multiple of your risk, and Mark, you might want to talk about some of your sort of general rules of thumb, because I know, when you go into a stock, and if your average, if your loss is 5% or your risk is 5%, you're not usually selling a stock if it's up 4 or 5%, because you're not really achieving any multiple of your risk. So when you get a multiple of your risk, when I get where I'm 2-3 times my risk. Let's say I risked 8%, and now the stock's up 3 times, 24%, 25%. I consider selling half my position at that point. Basically, I consider a couple things. One is selling a part of my position and financing my risk and allowing the stock to go to my stop, but I just break even. If I'm at a real decent profit, maybe I'm at a couple times my risk. Now I can sell half my position, move my stop to break even, free roll the trade, and still guarantee myself a profit. So if it comes back and it stops me out, I guarantee myself a profit. I also look at my average gain, and I'm going to let you talk about this too. I know you're going to talk about many of the same things, but you'll have your own take on it. My average gain is what I'm also monitoring. So you should always take a look. What's your average gain? Look at your last 100 trades, your last few hundred trades. If you don't have that many, look at whatever trades you have. What's your average gain? If your average gain, let's say, is 10% and the stock's 20, Mark, this is where I'll let you take over. What happens to your average gain when you sell a stock above your average gain?
It improves.
Improves your average gain.
Right. It improves your average gain. And we'll, we're going to get into this in terms of the math later. And yes, what we talk about, you want to let the math and the metrics work its way into your trading and help you make better decisions. So to Mark's point, when you have a good understanding of those metrics, it will help you manage positions better in real time. And that's the key, guys. Remember, we're looking at a lot of these past precedents, and this is really important to have pounded into your head. But, in real game time, that's where you want to let those things help influence you to make the right decisions. And I just wanted to highlight, though, that the Alibaba example is a really good one, because you want to think of some of these, we're giving you a lot of different tools, guys. And the key is to know how and when to use these tools. So we've got all these different entry techniques. Well, this was one particular one where, I think in the first Master Trader program, we didn't even have the 2 lower lows. You and David had developed that as kind of a rule and even set some of those precedents. And I remember, having an enormous position in this stock because it was set up perfectly. And this is the weekly. And then, switching over to Mark's point, where you can use that 50-day trail in combination with sort of 2 lower lows. And this stock just, and this was a big name. And I think this is one of my first individual $1 million trades, which is why it stands out, because I was able to put everything together to say, look, and it had earnings, it had all the fundamentals coming out of a primary base. And then you got the perfect breakout where you're able to put a big position on. And then finance a hold with what would have been a larger average position for me. So you want to see everything kind of building together. And it takes some time to master these things. And to our point about how the pros really focus on selling right. But you can just, really make a huge giant step forward in your performance as you start mastering some of these techniques. And I'm really a hybrid, to sort of explain where I'm not always looking to play things for a bigger move. But when I see that good follow through action and the stock isn't showing violations, that's where I want to sell a piece to finance that hold for a bigger move. But, everything comes with a cost. There's no free ride. If you're going to play the 50-day or trail rule, you just have to understand too that you have to cut a position to the size that you're comfortable holding, because you're going to have to sit through some pullbacks. And if your position's too large, you're going to wind up, putting too much volatility in your portfolio.
Yeah. And let me see if, okay, I want to make sure my microphone was on. And we're saving the best for last. The risk management section is one of our final sections. And we're going to talk about a lot of this in position management. So we're going to get deeper into this. We're going to get very, very deep into the math and the risk management and the position management and some really interesting techniques and some very mind-blowing things that it's called mind-blowing math that we're going to a section that we're going to talk about that you're going to be blown away. So we're going to get even more deep into this, but we're going to conclude today. Right now, I also put some other warnings that you can look for. You look at those charts, you go back and look at those chart examples, and you look at these tables that I'm giving you here, and you can start putting that together. And these are the warnings that you should be looking for, and the specific sell signals to get out of those stocks that you're profitable on. All right, so we'll conclude now, and then we'll see you next. I'm not sure what we're doing with another Q&A or not, so we'll find out. We got to let Bob talk here, and we'll figure out where we're going next. I just go where they tell me. All right, thanks, Mark.
Absolutely.
Yeah.
All right, guys, that will conclude the curriculum for day 3 of the 2022 Master Trader Program. We will be starting the question and answer session in about, let's take maybe 25 minutes actually. So to give a little bit more time for you to take a quick break, as well as let us get our questions in order. A bunch of them have been coming in. With that said, questions can be emailed to bob@minervini.com. And also, just as a quick reminder, we will be having the recording replay tonight at 6 p.m. Eastern Time. Finally, you will use the same login credentials for all sessions, including the live trading day. We will also have additional time for questions and answers on Monday. So please realize that we have been getting a lot of questions, more than what we'll ultimately be able to get through, but we do aggregate and congregate the general questions that are very similar to each other and do cover as much as we can. Also, a quick reminder is I know there have been some questions here that I see been posted about the Minervini private access services. Again, we're not really going to talk about that in a forum, but you can reach me at bob@minervini.com, and I'll be happy to go over any details related to the private access daily service, which we offer from Minervini Private Access as well. With that said, again, let's take about, not sure if we're going to put the timer up here for 20 more minutes or so, but no. So about 12:45, as you made, it's 12:22 right here now where I am, East Coast time. So why don't we say just about 20 minutes? And with that said, we'll be back and see you at that time. Real quick, you do not need to leave the room. The room will stay open, but we'll pick it back up at 12:45.
Recording stopped.